Good morning, viewers, and welcome to the 12th episode of Your Money, Your Taxes of Season 2. I'm Paresh Shah, a certified financial planner and owner of Paresh Shah Financial Services. And with me today in the studio is Mr. Lalit Abichandani, CPA, and my close friend who's here going to answer questions about personal taxation today. He specializes in US taxation, and he has been running a very successful CPA firm in New York. He and his firm prepare tax and do tax planning for businesses as well as individuals. In addition to the regular trading businesses, he works with the healthcare industry, IT industry, hospitality, and entertainment industry. He has done hundreds of offshore voluntary disclosures and streamlined procedure cases and has become an expert in FBAR, foreign bank account reporting, and the US-India tax treaty. He's a CPA and tax advisor to businesses, professionals, Bollywood industry, and a lot of film personalities. His website is yourtaxadvisor.com. Welcome, Lalitji.
Thank you, Pareshji, and thank you very much for great introduction.
It's my pleasure. Lalitji, this is the time of the year when a lot of my friends, when we're talking, they seem to have not filed their taxes on April 15, the personal taxes, and now have taken extensions. And what the CPA has made some approximation, and the biggest complaint is the tax is coming out to be very high. So today's episode, we'd like to learn about how the tax system works. What are these tax rates, and what individuals can do to minimize the tax that they're paying? So let's start with about our tax system and tax rate. Please tell us about that.
So Pareshji, let's start with the tax rates first, the basic rates, what they are. Basically, in this country, we have a progressive system of taxation. What that means is as you make more money, the rate of taxation goes higher. It starts out with basic 10%, but there are 7 different layers of rates that get applied, and as your income goes higher, the rate of taxation is higher. So the basic, as I said, is 10% for the first 18,000. Then it goes to 15% from 11,000 to 75,000. And then it goes to 25% for income over 75,000, and likewise it goes from 25 to 30%, 31%, 35%, and if you are so lucky that your taxable income is over and above 430,000, then the rate of taxation jumps up to 39.6%. So those are the basic rates that gets applied. We as professionals try to minimize the taxes wherever we can.
I mean, if it's somebody making $450,000 now, here we have them paying 40% on federal taxes, and then plus on top of it the state tax.
The state income tax as well, which could be between 3% to 11%.
Wow, so 11% is probably in New York or California.
Correct.
Where is that?
You're right, yeah.
Yeah. So someone living there is paying 50% of the earned money that they earn in total in income taxes only, to begin with. That just gets lopped out. So what can be done for them to reduce this? It is just a lot of outflow.
Pareshji, as everybody knows, the taxation is a very complicated situation here. But the basic categories that we have are deductions, exemptions, and tax credits. And I encourage taxpayers to know about it and educate themselves about it to try to take maximum advantage of these three categories. The deduction, the basic deduction is the standard deduction. So everyone is allowed $6,350 of standard deduction. Now, when you are filing joint, you get the husband's deduction and the wife's deduction. So that could be $12,700 of standard deductions if you don't itemize. The other option that you have is you can itemize the deductions.
Well, Lalitji, now you mentioned itemized deduction. Can you tell us a little more in detail? What exactly is itemized deduction? What are these items that you're talking about,
Paresh, this is the area that most people get confused between itemized deduction, because even though it sounds simple, there are basic 4 categories of expenses that can be itemized, but within each category there are so many rules and regulations that people get confused about it. I'll just briefly summarize these 4 categories. The first one is medical expense. Now, as you know, everybody pays health insurance and pays doctor bills and the co-payments. So all of those have to be put together. Your health insurance premiums, your co-payments, medical prescriptions, including travel to the doctor. Let's say if you're traveling from one city to another city to see a doctor, so you can include that as a medical travel. So, but again, it's not a simple solution that you can just add up the deduction and take that. The first 10% of these expenses are not deductible. So it's 10% of your adjusted gross income. So these expenses have to be over and above 10% of these deductions till you're 65. If you're over 65, then the rate goes down from 10% to 7.5%.
So just to interrupt 1 second, Lalitji, if a person is making $100,000, then only medical expense above 10%,
over and above
10,000 will be deducted.
Over and above 10,000 will be deducted.
Yeah.
But you have to be careful in adding up all these expenses.
Okay.
Yeah.
Okay. Yeah. So please continue. You know, you were telling medical expenses.
So the medical expenses is the first category. The second category is taxes. Now, if you're living in a state where you pay state income tax, that can be deducted. If you are not living in a state where there is no state income, then you can deduct your state sales taxes. Again, it is based on your income. There is a table that we have to use to arrive at the sales tax that you are allowed to deduct. In addition to that, if you own a home, your real estate taxes for your primary residence as well as your second resident.
I think I'm going to interrupt you 1 second here, because you said state income taxes or state sales taxes.
It's
that means
either of the two.
Oh, cannot be both.
Okay. No, you cannot add up. The Congress is very smart in this. They give you only one of the two.
Okay. So yes. Yeah. Go ahead. You're telling about real estate taxes.
Yeah. So within the taxes, the next section is real estate taxes. Now you could own 2 houses and deduct real estate taxes for both the houses, primary residence as well as secondary. The third category is the interest. Now, as you know, if you own a house, most of us, we have mortgage. So the interest that you pay on the mortgage can be deducted. This could be a sizable deduction for anyone and everyone who owns a house. The government or the IRS allows interest of up to $1 million of mortgage. So that means, let's say if you have 5% interest rate that you're paying on $1 million, you could deduct $50,000 of mortgage interest from your income. That can be sizable amount. In addition to that, you can deduct investment interest up to and the investment income that you have. So let's say if you borrowed some money and you invested somewhere and you're paying investment interest of $5,000, as long as you have an income of $5,000, you can offset that against the investment interest that you're paying. That was the third category. The fourth category is miscellaneous deduction. Now, anything that does not fall into the first 3 categories is put into miscellaneous itemized deductions. It's a long list, so I will have to read that from this. So the miscellaneous expenses are your job or employment related expenses like travel, supplies, union dues, work related clothes, or if you are taking seminars for your education. The next is your tax preparation fees or legal fees that you may have paid during the year. The next category after that is casualty losses, meaning if you lost an item in robbery or theft or in any kind of accidents, job-related accidents. The next category is gambling losses. If you win in a casino, it's only when you win in a casino that you can offset your gambling losses against that. So the gambling losses are limited up to your income, your gambling winnings. And the next is safe deposit, box rental, etc. So some of these expenses, they have a 2% base, meaning the first 2% of your adjusted gross income, like you said, income of 100,000. So the first $2,000 will not be deducted, and anything over that will be deducted.
Lalaji, very honestly, just listening to all of this scares me. I mean, this is such a long list. How does an individual or how does a person keep tab on all of this, and how do you make sure what you should take standard or itemized, and how you should maintain lists, and it's just mind-boggling,
Paresh ji, if you have a sizable income, then I urge taxpayer to sit down and go over all these items one by one and add it up, those related expenses into a spreadsheet or something, so that when they go to their tax advisor, they can give it to them and try and maximize on that. We try and focus on that. I sometimes have to pull teeth out of, from taxpayers just to get these expenses, and we have to make multiple trips so that we can maximize on these itemized deductions.
Wow. Then you mentioned about exemptions. So I mean, what are exemptions that are available? Can you give us some lists or some ideas about the exemptions that a person can take?
So Paresh, exemptions is basically the number of members within the family that are being supported. So for example, if you are husband and wife and you have 2 children, you have 4 exemptions. If you are supporting anybody else within the family, you can add on additional exemption, as long as you qualify within the rules. And each of this exemption is $4,050. So if you are a family of 4, which is a basic family unit, you could be taking deductions of $16,200 in a given year. So I urge people to make sure that they do add that in their tax return to minimize their taxable income. Also, if they are supporting their parents, for example, to make sure that they are included on the tax return as well, and they are not missing out on these kind of deductions. Compared to itemized deduction, this is a very simple thing. So you know how many members there are within the family that you are supporting, multiply that by 4,050 and you have a deduction.
Lalaji, I know that
it's an exemption, yeah.
Yeah, I'm just going to go a little off here, and I remember in one of the previous episodes you have described, for the benefit of the viewers, how if there are parents who are coming from India or from their home country and are staying with them in the US, even they may be eligible for some of these deductions. Can you define that a little more?
Yes, so when they come the very first time, they can apply for a tax identification number. Without the tax identification number, you cannot take an exemption. So there is a process that we can help our clients in getting a tax identification number.
Right.
And yeah, once you have that, you can take the deduction.
Right. Lalit, there is a lot more to go through, like tax credits and all. But today we are going to kind of end because we are running short of time. First of all, Lalit, thank you for taking us through this complex topic. And viewers, as you can see, the rules are complex. There are plenty. And what I would definitely advise is to take the help of a professional, a CPA, who can guide you through all of these lists so that you don't miss out on them. If you miss out on some small things, then that could mean a lot of loss in taxes for the years to go forward. And I've personally seen the benefits of working with somebody like Lalit. You can forward all your questions to him at Lalit at his email address, or you can look up his number on his website, yourtaxadvisor.com, and call him with your questions. I definitely urge you to use him as a resource, because this complex area of personal taxes can really be made beneficial to you by a good professional. So once again, thank you, Lalit for great information. We'll continue on this topic next time.
Thank you very much, Paresh. It was great. And like I said, we do specialize in sitting down with people and making sure that we do give them deductions, exemptions, and also tax credits that are applicable in each case. Thank you.